Thanks, Rob. Yes, welcome everybody to another episode of DeepRoots, where we dive into the best practices for cannabis brand expansion. Interesting show today. In the past, we've had a couple of brands on here that have pursued a licensing model where they're going to license their IP and perhaps support some sales and marketing initiatives by their brand, their licensed provider in a new market. But today we are interviewing a company that has taken a slightly different approach, where they have acquired licenses in new markets. So without further ado, let's bring on Erin Gore, CEO and founder of the Garden Society, and to share her experiences with us. Erin, come on in and welcome to DeepRoots.
Hi, thanks so much for having me today.
So Erin, it's really fascinating. I think you're kind of an inspiration for a lot of companies because you're not a huge company. You're not an MSO. You haven't raised hundreds of millions of dollars. Yet you've been able to enter new markets with a different model, one where you acquire the license and you build it out from there. Give us a little background first about what was the thought process that you kind of analyzed, what went into your strategy for deciding, I want to own the license, I don't want to do an IP licensing deal?
Yeah, I think it's a loaded question, so maybe I'll break it down. And first of all, one correction, we are an MSO. We are a multi-state operator.
True.
We might not be publicly traded and we might be small and growing very fiercely right now, but I like to put that out there.
Yeah.
I think our strategy for how we took on expansion was really derived from what we did an analysis of our strengths. Nancy at Wana is a dear friend of mine, and she's been, kind of chumping in my ear for a long time about the need for Garden Society to get out of California. We all know the difficulties of the California market, and we experience that every single day within the company. And so we really looked seriously at how to expand out of California starting in early 2021. Eric, you and I had a lot of conversations about it back in the day. And we actually looked at the traditional licensing route and we said, okay, this is the playbook, this is the path, this is how we have to go. And we started down that process. We got into an LOI with an MSO to be not named. And it became very obvious very quickly two things. One, they didn't have the quality programs or sophistication to make our products at the quality that we expected. So they didn't have an allergen program. They didn't have the technology. They could only make certain types of our products. We're an interesting consumer brand in that we're cross-category. So we have edibles and pre-rolls and concentrates and infused pre-rolls, and that's important to our brand. And so finding a person or team or group that could make that depth of portfolio was really challenging. And then we found that, we got into it, and then it became very obvious they were not interested in launching Garden Society, the brand, but they did want access to our technology and trade secrets that we created. So I think an important backstory and distinction for us is that I am a chemical engineer. I have a Lean Six Sigma black belt in process improvement. I spent 11 years in CPG manufacturing. And so one thing about Garden Society that a lot of people don't know is that we have our branded products, which are in retailers across California, but we also have a contract manufacturing arm of our business where we make products for top 10 leading brands across California as well. And so that part of our business is bigger now than our branded sales. And so when we looked at why we can do that, it's because we focus on quality, we have our own technology, we have lean processes. And when we looked at expanding, it was very obvious this partner wanted that, but didn't want our brand. And so we were in a conundrum. What do we do? And I was kind of like, well, we're obviously not going to give away our tech. So we need to find a new partner or we need to rethink this. We had an investor at the time who really challenged our limiting beliefs and said to us, Erin, if you can do it in California, why can't you do it anywhere else in the country? And I thought, well, I don't know how to raise the money. I don't know how to get the licenses. And she really pushed on us to say, bullshit, and you can. And so we really changed our approach and philosophy because we realized like we are operators. That's what makes us good. That's what's let us survive. And so how do we become an operator through expansion? By actually operating instead of just licensing everything away. And so that was kind of the precipice of the change of technology, really owning what we're good at and our strengths and how we should think about expansion to play to our strengths instead of to give away our strengths. And that's where we got to this new approach.
So you leveraged your core competency, which was manufacturing and operations, and said, we can take this model, this can export.
Mhm.
However, you knew when you determined that there was never probably in your mind a question whether or not you could, but you had to look at the cost associated with
Mhm.
expanding into new markets. So where did your investors challenged you, but obviously they must have been supportive in financing some of this growth. How did you look at that financial model and say, okay, this is very different than licensing my IP and getting a mailbox check? This is all in. How did you balance that requirement?
Yeah, it was expeditious but obvious at the same time. As soon as we started to really remove our barriers of our own beliefs of what we could do and really build the model and build. We have good margin in California, which I think is different for many operators. So when we look at operating in these new markets, these limited license markets or these emerging markets, and looking at the retail price of product and the wholesale price of product and the efficiencies we know we could capture, we started building out some simple pro formas, and it became very obvious very quickly the return on capital and the opportunity to drive profitability across the business, and how that gives us permission to double down on our brand. And so we really believe in factory utilization to drive brand expansion. So running cash flow and driving profitability to give us the opportunity to reinvest back into the brand on the consumer side is something that we're really focused on. And this model became so much more obvious to us with our strengths and our financials and our margins and our technology as an opportunity to drive the business forward versus a straight licensing deal. I think the thing people don't understand about straight licensing deals too is that there's just a licensing deal and you receive a check. Most of it, you have to invest in sales and marketing. You have to drive brand awareness as the brand in the market. So there is a significant capital investment in brand expansion into those markets, unless you have unless you have a very unique relationship with that partner. But in today's world, it's rare to find that. Most of the brands are driving and owning their own sales and marketing in those markets. So it's not like it was a all or nothing capital conversation. It was how much would it take to stand this up versus how much do we have to invest to build brand? And is there a middle ground that we can actually get behind that drives an ROI and drives profitability, drives more control, and drives better returns for the business? So it was an interesting exercise, and it was an obvious exercise as soon as we started down the path. And then, the rest is history.
Yeah, I think a lot of brands that I've spoken to really struggle with when they do the licensing model, maybe let's just say 10, 15% licensing fee, but they're asked to support sales and marketing. They're asked oftentimes to send the packaging or what have you. And the margin that you're playing with, 15%, of a royalty for your brand, that's very small, and you're contributing back, and sales and marketing can eat all that up. So you realize that, okay, the barrier that going into a new market, you needed to do that. And you looked at the other 85% of the economics and said, why don't I take that, right? Now, did you look at that and say, I need cultivation? I mean, I got to go fully vertical? Or did you say, I'm sticking with
Yeah,
it?
so I think this is an interesting thing too, and it's something that's allowed us to be successful. Is I really believe in understand your strengths, understand your weaknesses, and stay in your lane. And so we're a little bit of the anti-verticalization or MSO, if you will, because we don't do cultivation. We know flower incredibly well. We have a strong expertise in it, but we're not cultivators. We have incredible cultivation partners. And what we've seen in these emerging markets as they mature is that specialization is going to be really critical, and that there's a lot of opportunity to own a part of the supply chain. And so we felt like that as a brand trying to license into a new market. We couldn't find an expert in manufacturing. They were somewhat okay in lots of verticals, but we wanted somebody who was an expert manufacturer, and that was very challenging to find. And so for us, we really realized it's an opportunity. The other thing is by staying in our lane, we can get economies of scale, we can get margin capture, and that 85% of an emerging market is very different than 85% of the California market, right? And so when you look at the pricing and you look at the wholesale pricing and the retail pricing and how it all stacks out, it's the same amount of effort or more, but as a brand, not dramatically more, right? And dramatically more returns to the business. So that was the precipice for us. We couldn't figure out how to make it work under a licensing model supporting sales and marketing. It was, maybe breaking even. And under this model, like, it's profitable almost on day one. So really controlling that and driving that was the decision maker of how we decided to go.
So for people that aren't that have tuned in, but Ohio is one of the markets where you're up and operating. New Jersey is another market where you're underway. Give people kind of a order of magnitude. I think we've all gone to these new markets, or even California. We've seen large companies build out huge facilities, beautiful, GMP, whatever. I mean, it's amazing. You looked at that and you said, look, I don't have the capital to do that. So what were some of the strategies that you could deploy to give you that effective return on capital? And how do you build something small yet efficient and effective?
So I think the interesting thing to start about for me was, in a limited license market, there's a lot of distressed assets right now. There's a lot of people who won licenses in 2016, 2017, 2018 who haven't commercialized them. And so finding access to that as a place to start, we really believe at the business, and maybe this is the engineer in me, but step one, evaluate, pivot. Step two, evaluate, pivot. And I hate the word pivot. I like the word learn. Learn and adjust. And so we started with Ohio because it was part opportunistic. We had somebody presented us with a distress processor that was given a timeline by the state that they had to operationalize or they were going to lose their license. They had no path to operations. So they were highly under distress. And it was also kind of a more obscure market. So it was nice for us to learn in the Ohio market. It's highly regulated by the Board of Pharmacy. It's a very challenging medical market, but it's also really an incredible market and has a lot of potential for what's coming. So it was like a very interesting kind of sandbox, if you will, for us to realize. We learned a tremendous amount, things we do better and different next time, things we do the same. We were able to acquire a license for $300,000. We then had to operationalize the license. So we had to fund it with equipment. We had to operate, give the business a loan to start hiring people, paying payroll, doing compliance, taking it through completion with the regulators, and then turning it into launch and turning it on. So it's been a very interesting project, but also incredible at how we could templatize our business from California. We already know how to operate in California. So we basically created the templatized SOPs playbook, and now we're replicating it across the country. What's also proven really interesting as you scale multi-states is like the incredible need to network within the teams. So the gummies, for example, we run the same equipment in both facilities. We have the same recipes pretty much in both facilities. So there is a lot of cross-learning and cross-collaboration to try to scale efficiently and to bring expertise across the business. So that ability to templatize has been really phenomenal. And then I think to your last question, the biggest thing I see in a lot of these distressed assets, and there's plenty in California right now too, is they don't build for the market. They build for what they think is the sexiness of what they should build. So people really oversize equipment. People really oversize manufacturing specifically. They can make enough oil to supply the country of oil. And at the end of the day, what you need is to keep yourself and your machine utilization going. So scale as the business scales and build as the business builds versus all this huge CapEx up front. And then you actually automation and equipment doesn't run well when it's not running. So the key is to keep it running as much as possible and to scale it as the need scales. And so I think being a lean engineer, having worked with the largest CPG manufacturers in the country, having that be my foundation and background has been core to us being able to scale efficiently and cost effectively.
So you got Ohio done for all in, up and running and initial inventory for how much? What did that whole thing cost you?
Sub $1 million.
Sub $1 million. That's amazing. That's amazing. And so even then, I think
it's a loan back to myself.
Well, I think what's interesting is what you also did, which I think was really smart, is you really got a sense, you sized the market, right? So you didn't go out there and say, oh, as soon as I put my product on shelves, I'm going to be doing tens of millions of dollars in revenue. you weren't focused on building a massive amount of inventory. You were talking about more consistent, smaller runs, and
yeah, that's one thing I think a lot of people really get wrong about cannabis. And as an avid consumer, there's a lot of people who are not cannabis consumers, and that's fine if you're in the industry. I don't judge that, but we're avid consumers on this side. So I think what we really appreciate is freshness. We appreciate like when you produce it. We know in California it's incredibly fierce competition, and so like retailers are rejecting things past that 60-day mark even with flower, right? So like timeliness and batch size and freshness really matters. And what's amazing from a cash flow point of view is if you're not trying to build a year's supply of oil and you're not trying to build this huge amount of inventory because you're unrealistic of what the retailers are actually going to sell, and you actually really understand how it works, you can build just-in-time manufacturing that takes your cash to cash cycle. So you spend money to buy inventory, to build product, to test it, to sell it, to collect. You can take that cash to cash cycle down to a manageable weight where then you're having consistency instead of this big swing, which is really hard to manage too. So like, you guys know, like a lot of lean, there's some really incredible companies that are experts in lean, and they are just really great case studies that I'd love to see more of that brought into the cannabis industry, because it's going to steady the industry, right? Instead of so much of this, like how do you like really build just in time? How do you really put good systems like Kanban systems and things in place? How do you really manage your cash well, so your cash isn't sitting there on the shelf as expired product?
Yeah. No, I haven't heard many cannabis companies use just-in-time manufacturing, so kudos to you there. No,
maybe it's because we're women entrepreneurs and we're underfunded and it's impossible to raise capital, and it's like out of desperation, like we had to sell boxes of chocolates and boxes of gummies to make money, so like for us it was like how we built our business. We couldn't over fundraise, we never have over fundraised, and so I think it's a testament to like necessity.
Well, scrappy and quite the badass. But now you haven't really gone it alone, right? You haven't. It's not that it's just your world. You've brought some California brands with you. You've brought some partners. Talk a little bit about that, because I think that's what California brand, they're looking for, a trusted partner. And boy, I mean, nothing like trusting somebody that you see every day in the market and launching great products. So that was also a competitive advantage that you have going into these new markets.
Yeah, like we did a SWOT analysis and strategic planning, and the one thing that we really anchored on was Legacy California as a strength of ours, because we are legacy. We're medical market California operators, and we have really deep relationships in the California market. And so as we were thinking about going, we had to do a capital raise for New Jersey, and everybody knows the capital markets right now are just destroyed and insane. And so we were thinking really creatively, like if we look at our SWOT, what are our strengths? This Legacy California is a strength of ours. We know that from the tech, we know that from the MSOs. Like, how do we deepen that, and how do we find more strategic partners and deeper partners? And so it was an interesting journey for me to get there. Originally, I thought I wanted to incubate and scale women-owned businesses, because women-owned is so deep and core to my heart. And then I realized the challenges of scaling these businesses and what was required behind it. And then I also realized like we didn't have the sophistication internally to do it. Like we're trying to do it for ourselves, let alone other brands. Like there's no way we can do that. And so just really coming back to our strengths and weaknesses, and then really taking that idea of like, there's something special about California. It's not the small businesses of California, but like really understanding the MSOs and really getting the big businesses of California and the big brands of California, legacy operators, is like they're having the same challenges I was having trying to go out of state. And so positioning that as like, let's work together. You trust me, I trust you. I'm going to do right by you because I do right by me, because I make my own products. I have a lot on the line for my own brand to make sure that's done with the quality level we expect. And while Garden Society is a small brand in the California market, it's a beloved and respected brand for the quality of our products. And so that gave us permission and these other brands to trust us to take them out of state. So we signed some really incredible partnerships that we're going to be announcing soon. So TBD on that. Sorry, I can't talk about it here. But what has been awesome is that as we build the pro formas, as we look at forecasts, as we look at investors want to de-risk right now. And they also want upside opportunity with these emerging markets. So if I've proven I can stand up in Ohio, gives more confidence to Jersey, and then I've proven that I've got incredible partners ready to rock, in Jersey really gives my financials a lot more robust stability to it and a lot of confidence behind what we're going to do. We've been able to actually successfully raise capital as a result. And so those partners they also solved some problems in California to me. They solved some capital problems. They helped me have sexiness with my investors to get momentum there. So like thinking really strategic about how to partner and more creative of how to get that capital in the door has been very beneficial for us.
So your case study is you went to Ohio, you bought a license, you stood up the facility, you brought in some partners, you launched your brands, and you are now operational there. That whole process from when you started to where you are today, how long, what are we talking about here in terms of?
It took us a year. I would say one of the challenges with taking over distressed assets is there's landmines in distressed assets that you might not know about. So we hit a speed bump over the summer on a regulatory delay that we had to navigate through. So we would have been up sooner if that hadn't happened. So, you know, for what we're looking at for Jersey, we're looking at like 9 months or so, and we're on track for that. So we feel good about it. You know, Jersey is an interesting landscape. And Jersey, we didn't take over a distressed asset. We actually applied in Jersey. So the interesting thing about these emerging markets is that, and our methodology is being an operator, there's a lot of opportunity to take over distress, but distress has, like I said, landmines and problems, and, you know, it's distress for a reason. Yeah. And so in Jersey, they were really strategic for women owned and diverse owned, as we all know. And so I got super high one weekend and busted it out with a friend, and we just applied. And you know, people are like, how'd you do that? Who'd you hire? And like being an operator, we had the playbook because it's our business. And so we went for that. And so now we have our conditional, we're converting it to an annual right now. We found some great people in Jersey to work with, landlords and partners, cultivation partners. The other thing I think that's interesting about verticalization is, so in Ohio, our landlord's an incredible partner to us as well. They're one of the top cultivators in the state. So I think you can be specific, but you can have strategic partnerships, which a lot of people don't think about. And so like pairing up with incredible partners in the emerging markets, but even owning your lane is really, really important. And that's been a strategic advantage for us because, you know, not being in Ohio for myself as a CEO, like things go wrong. What about this? What about that? Who's the local contractor? I need a crew that can be here tomorrow because it's broke. And so having somebody boots on the ground that you trust and is invested in your success is also highly beneficial. So, you know, that piece of it, I think, shouldn't go unsaid, and that how big of a role that plays in our success.
Well, you're building it in every market you go into. You're not just kind of running in and saying my way or the highway. You're building an ecosystem, right? You're building a partner ecosystem that is going to allow you to thrive, your partners to thrive. It's clearly win-win-win. What was when you look at new markets and where you're going, is the way that those states support women-owned businesses an important caveat to see what are they doing? Obviously, not just women-owned, but minority-owned as well. How does that play in? Because obviously, it sounds like New Jersey, you had some real benefit by being a women-owned business.
Yeah, I mean, that's definitely critical to it, right? Ohio doesn't have any specificity around that, so it's a little bit different. It'll be interesting how adult use rolls out in the Ohio market. For New Jersey, what they allowed with women is you didn't have to have real estate tied up. So what that meant is we didn't have to raise capital before the licensing process. We could apply for conditional, get it, and then tie up capital to convert it. So we were able to be guaranteed a license. New Jersey real estate's complicated and interesting. So like that's a whole other landmine, but it meant that we weren't burning millions of dollars in the year. It's taken the regulators to approve all the conditionals. So you know, it was strategic for us from a capital point of view, and we're really capital efficient. My investors are shocked at how capital efficient we are. But that's because we try to be strategic and make these types of decisions. I think as more markets come on, it's going to be interesting. I think the women-owned, diverse-owned, minority-owned, social equity, we are not social equity. We have not been incarcerated for cannabis. So I just want to put that out there. So I think it's a really interesting conversation, and how do you show up authentically, and how do you really provide strategic opportunity for diverse ownership? Because I think every state genuinely wants it, but it's very complex and difficult to do. Of course, we're interested in New York. You know, everybody's talking about New York. We really feel like New York's going to be a second mover for us, and that we have the opportunity in Jersey to build right now. And then as New York shakes out, there's going to be a lot of opportunity to determine how to participate in New York. We've talked about this hub and spoke model, so more traditional CPG, where we are going to have regional manufacturing. We're not going to build manufacturing in every state unless something regulatory changes, but we can have a lot of shared resource around that. So we'll have sales and marketing support. You know, when you look at California and the size of California, it's like 3 states on the East Coast. So if you look at like the geographic opportunity within the Northeast and the tri-state area, the opportunity to take resources from New Jersey and build in New York and build and launch in Massachusetts is going to be really advantageous. And then also partnerships we build as local operators. So I think it's a little bit TBD of our future markets. Of course, we have a pipeline and we have a lot of opportunity, but we really want to build thoughtfully into where we go next.
So that hub and spoke model, like you said, there's tons of shared resources, sales and marketing, same people selling in New Jersey, selling in New York. You got finance. Obviously, you don't have the actual product, but then it sounds to me like that you could deploy in New York. You said you don't need a manufacturing facility in every single state. So this hub and spoke model allows you to have the hub, which is where you have your core business, where you're manufacturing, you're doing everything. And then you have the spokes, which could be Massachusetts, New York. Is that how you're thinking about it?
Exactly. Yeah. So then we can hire, we don't have to have a sales manager in every state, for example, unless that's required. We can hire sales and marketing and deploy sales and marketing resources. Even for contract manufacturing, we're a contract manufacturer. So there's a lot of ability to do reciprocity into new markets. Also, we have inventory. So a lot of times with edible manufacturing, we would supply the ingredients or we would supply the packaging. And so having a hub and then supplying packaging next door is a lot simpler when you think about like big picture how to scale this. So I think it's going to be really great. We're getting pushed a lot to do a lot more states right now, but we're really focused on executing what we have in front of us before we start spoking out, if you will.
Yeah. Well, New Jersey sounds like it was a little more expensive than Ohio, right? Now, how do you balance fundraising is all about risk mitigation, right? It's called venture capital, but investors don't really like risk. They want something that's more, clean cut. But you've been doing this kind of on the fly, yet you've been funding the business at the same time. So you haven't had the capital to just do it and then say, look, I can do it, give me more money to do new markets. You've had to kind of build this on the fly. You've had to raise the money on like, I'm doing this and I need some capital to execute. I mean, to your credit, that's a tough sale, which you have achieved, and getting investors over the line to believe in your capabilities. But at some point, it's like these are expensive forays into new markets. How do you kind of look at that capital allocation and on a market by market basis and say, wow, I could go into, is it the size of the population, or I could go into the Connecticut for a lot cheaper, but it's only a few million versus New Jersey. What are or is opportunism also play a role in all this?
Well, so I think it's a lot more strategic than you might think with the capital side of it. I have incredible investors and advisors who've been with me a long time and are really champions for what we're building and see it. And, we have really focused, we call it radical transparency in the business with our investor community, with our communications, with our investor updates. A lot of people coach and advise me too, because like, I can't do this alone. I have incredible co-founder Carly. We have these really great ecosystem around us supporting what we do and helping us problem solve. So that's the first thing. The second thing, we did do our Series A. So we did a $7 million priced financing in 2001. And we used part of that capital intentionally for Ohio. So like we knew we were working to go out of state. We knew we were going to try to do this. We didn't know exactly what and how, because at that time we were looking at licensing deals with MSOs, but we knew we wanted to get out of state quickly and we had budgeted a certain amount. So like we had actually strategically raised the capital. We changed our strategy, which everybody approved of and thought was a really great move, and now is proving to be correct. And then with those same investors, we actually, kept them updated all along the way that we applied for Jersey, we're going to do this. So then we went out for this capital round. I think the interesting thing about us is we've raised capital different than other companies. We haven't done big, like sexy, huge financings that have garnered national attention because we don't need it. And that's not the type of company we're building. but we have been really thoughtful in building a women's slate of investors. So many of the leading women in the cannabis industry and out of the cannabis industry are on our cap table, which has been incredible. Women really show up for each other and support each other with introductions. It's how we found our lead. It's how we got our next, we found our lead on our A. It's how we got our lead on this round. So I think that's been really intentional. We've also tried to be specifically focused on diversity and people of color on our cap table, which is really unique for cannabis. And so I think, showing up in that way has allowed us to have a very diverse cap table, which has then propelled it outside of the traditional cannabis funds, because we have unique, different investors that aren't necessarily totally deployed on capital given the market conditions. So we have family offices, we have high net worth individuals. We're really focused in that lens. And what's really cool with the time we're in is people really want to support women founders right now. And so seeing sustainable cannabis in more of a CPG forward way with building manufacturing, and they see the potential for an exit, they see the potential for profitability and scaled profitability and returns. So that's where we've had momentum, is that it's just a really unique approach compared to what other people are doing.
Yeah, no question about it. Kudos again. One of the things that you have done that not many other people have done in any, in a proven model, is you have partnered with the MSOs. So when I talk to brands, a lot of them say, look, I started this business, I love it, I'm passionate about it, but someday I would like a liquidity event. I'm in it, I raised money, my investors want liquidity. At some point, I want to be acquired. And even despite the M&A market not being, so frothy right now, there are always considered to be a certain number of buyers. We call them the MSOs, the publicly traded companies. There's probably 15 of them that are truly relevant. And so a lot of people say, well, I want to partner with the MSOs. I want to get on their radar screen. And the best way to do that is have them sell my product in those new markets. You looked at that, you talked about it, but you realized that's not a partnership, right? You determined that that's a one-way partnership. That's not a win-win. That's good for you. And you've engaged with them and you've done multiple deals with MSOs on a more of a partnership basis. So I think it's fascinating. You are on the radar screen of these MSOs. They know all about you. And despite the fact that M&A isn't really a hot item, you've kind of de-risked any future deal by working with these people, by proving to them day in, day out that you're capable of running a strong business. And so you've de-risked the execution risk in a transaction. But take us through that, the relationship building there, and why you took a different approach than others who just say, have them sell my product and they'll see how great I am, they'll want to buy me.
Yeah, no, it's a really good question. I mean, it comes back to that original realization with the MSO when we were trying to do the licensing deal, and they were just it wasn't necessary for them to sell our brand, but it was necessary for them to have access to better manufacturing technology, right? And so that kind of started us thinking. I also have some really great friends who work at different MSO companies. And so I really started exploring at conferences, smoking a joint outside at the conference, or, over dinner, or, how does this work? Like, you guys all buy and sell each other's, like, how are these deals really happening? Right. And what's become very obvious, and I think everyone knows it, it's like the worst kept secret, I guess, in the industry, is there is a lot of horse trading between the MSOs to support each other. So I'll do this, you do that. I want to do this, I do that. So we had to get into this horse trading, because when you think about these limited license markets, they are dominated by the MSOs. In California, it's not. California, it's the California operators, it's different, it's like legacy, right? And there's large retail chains and cultivation and all this stuff. But as you go into new markets, it's like very dominated by the MSOs. And so we had to think about how do we even get on their radar? Why are they going to sell our products? How do we have these relationships with these people? And so it started this idea of like, who is in California? Which MSOs are in California today? And that's one thing we were really intentional around. And then how do we support their efforts in California and add value where we know we can add value? And instead, maybe we give up a little bit of margin over here, but we get something extremely valuable over here. And we start showing up as being a partner to them to solve their problems where we have value to add, and then in return request what we need in these new markets. And so It's been tremendous for us, being a lot more strategic and methodical. Also, we're a good partner. We pass quality tests. There's a lot of operators in California who can't pass a quality audit by a publicly traded company because, in California, it's a little more loosey-goosey, and these publicly traded companies have more to lose. They have things they care about differently than maybe a legacy California operator. So we're able to cut the difference where we actually have the sophistication and the experience that they respect. They see the value we add. They like their supporting women-owned businesses, and then they give us what we need in these new markets. So it's been tremendously valuable. It also completely opens up an acquisition opportunity in the future. We're not talking to them about this right now because clearly we need to build the business and really build scale into it first before we go there. But like by being a partner early on in a good way and scaling that into these markets by being also a good partner, then, and what's nice about this is it's not independent. We're not licensing through one, because if you license through one, a lot of times the other ones won't buy your product, right? So like we're de-risking the singularity of working with an MSO by adding value on this side to many, which allows us to be sold over here and sourced from by many. So it's been interesting, and I've never been on so many lopsided conference calls. Like there'll be like 2 of us and like 17 of them. And so you're like, wow, okay, who does what? Like, what's your job title? It's giving me a lot of new ideas of organizational development and title creation. But it's just, I see why also now, as operating in multiple states, I see why they built what they built. So I don't mean it in any disrespectful way. And they're really good partners to us that we're excited to really scale together with.
I think it's hard for a lot of people to look at their business and say, I'm a small brand in California, and I have a clear path to adding value to supporting the problems of the MSOs. I can do that. You determined you could. Now, I think you said in the beginning of the webinar that you started talking to them initially about like, yeah, take my brands, and you said they didn't even really want your brands. But as soon as you started talking to them as in collaboratory terms, and you said, I can help you in California, all of a sudden everything changed, right? So what are some specific examples, and what gave you the confidence that you could solve, MSO's problems in California, because they run deep?
Yeah, they run deep. Because again, what are we good at? We know what we're good at. We're good at this little thing, right? It's a big thing, but like we're very focused at what we're good at. And what do you have to lose at the end of the day? What did I have to lose? I might as well try, right? Because I can be bold and I can be confident and I know what we're good at and I can deliver. So if I scope it for my team to be successful, to deliver it, and we achieve that, then they're going to only continue to see value in us and add value to that. So like I was able to build those personal relationships with key decision makers at the MSOs through showing up in the industry, leading with values, being transparent and honest. And then from that, I was able to get small opportunities that I turned into larger opportunities and was able to parlay into more and more. And so I think, I think the thing I've learned over the last year and a half is like, really this industry doesn't have a playbook, and it's really everybody's struggling, period, across the board. So like sitting here and being authentic and how can you solve other people's problems, specifically as it relates to manufacturing or contract manufacturing. I could make product for people cheaper. They could buy it from me cheaper than they could run their own facility. And I proved that to them. And so everybody's in a cash constraint and everybody's having problems. And being able to run just in time and keep your inventory levels scaling and growing by also saving you cash is extremely valuable. And then in return, just treating me like any other vendor and giving me shelf space where I need it is extremely valuable to me. So parlaying that and being really thoughtful and intentional and strategic and taking risks, because what did I have to lose? They say no, like, okay, fine, next, like whatever,
Yeah.
And so that was really the impetus for how we started to create those relationships. And I have some incredible champions at those companies who have done tremendous for us. And so, really advocating as women owned, saying like, hey, you have a diversity program. Like, why don't you work with diverse owned vendors? And like, I'm here and I want to work with you in California, and this is how we're going to do it. And then getting those people to walk the talk that they say has been really great.
Yeah, I guess what you're saying is there's a certain quid pro quo that like I'll help you, you help me. But in the beginning, you heard from them, like you had what I think a lot of people experience is that is, okay, either you don't really want my brands, but you want my expertise. You want me to come into your market and teach you how to do something, and you're not even going to carry my products. I could imagine somebody would have said, like, you know what, I'm not, no, I'm done. You said, no, there's got to be some other way. There's got to be something deeper here. So you were probing around, ways that you can support them. And now, in fact, in Ohio, you can get on the into the stores of the MSO's owned store retails, because you've been able to demonstrate that you're a value-added partner when you're actually not really doing that much for them in Ohio. You're doing a ton for them here in California. So that must have been like, I mean, kudos for getting through that, because I would have logically said, like, oh, they're just trying to steal my IP. I'm done with these people. Right?
Yeah, I mean, that was my original response. But then they realize this is a small industry, right? And you're like, I can't just tell them to buzz off or F off, as you can imagine I'd want to say. I mean, I might have said that in my comfort of my office in my house, but you can't do that when there's only 15, I think you said, MSOs that exist, right? Of any kind of, not any kind of size, but it's a very small industry. And so I think this is one thing. It's just like understanding what are people's pain points, what do people need. It's just like the sales process, right? Like good sales managers, they understand what are those buyers' pain points, how can they solve them, how does this product get there, what are those consumer pain points, how does the product solve it. So the same thing, but on a more strategic level, like what are my partner's pain points and how can I solve it in a way that is my strength, and so that I know I'm going to be successful at it. And then how can I be honest with that partner about what I need in return? So it's not just solving their problems for nothing in return. You scratch my back, I'll scratch yours, because the world is a world of horse trade. So what do I need from them? And I make it easy. Usually what I need from them is very simple. I need shelf space, for example. And then in return, I'll drive your cash and cost reduction down in a way that solves your problem that you don't have to worry about anymore. So it's been good. It's interesting how it's going to scale. I think, there could be a lot of challenging conversations ahead, potentially, as we continue to scale and get larger and become more impactful in our emerging markets. But, I look forward to those conversations. And I think, like, as long as you're truly adding value and being honest, like, people want to work with good people, because there's too much BS in this industry. And so, I think we can really scale them.
Yeah. Quick shout out to anybody who wants to ask a question of Erin. Obviously, you can see the depth of answers you're getting here is super informative. So if anyone has any questions, please feel free to lob those in. Let's talk about, so one of the things that was interesting, we started this whole conversation saying, kind of conceptually saying, you're acquiring a license in a new market, and you're saying, like, people come to the conclusion like, wow, she's going it alone. But then, as we discussed, it's clear that you're not going it alone. You've formed lots of partnerships. You've got California brands that you're bringing into new markets that have incredible impact on funding, sales and marketing support, and I'm sure other things, biomass, I'm sure all those different things as well. So there's real financial benefit. You've partnered with the MSOs to have some services that you provide to them here in California in return for shelf space in the markets you're going into. As you sit here today and you look at this crystal ball, there's a lot of companies listening to you today saying, I'd love to partner with the Garden Society. What are the areas that you would continuously be looking for collaboration with? What are places to play? What sandbox can you invite people into in terms of collaboration moving forward?
Yeah, it's a good question. So we're definitely scaling our manufacturing business in California. So if anybody's looking for manufacturing services, one thing we do is we don't do product development for people. So you need to have a developed product. If you need help with that, we can guide you to people who do that. But anybody looking to scale in California with quality operators that care about quality, we're not the lowest price on the block, but we do a really great job for people. That's definitely open and growing really quickly. Along with retail partners in California. So, there's a lot of interesting brands in California trying to go out of state, especially retailers. And so any retailers who are looking, who don't carry Garden Society products, we'd love to have strategic conversations there. We are currently expanding in Ohio with brand partners. So people who are interested in going into the Midwest and Ohio, I'd love to have a conversation. I think it's going to be really critical for the Ohio market. They understand the regulatory framework. It's very challenging and different. So I can be honest about that to see if it's a good fit, but that is an opportunity. We're pausing on New Jersey partners right now because we have incredible partners already solidified, and we need to get forward into launch more. But then when the time's right, we're going to open that back up as well. So those are 3 ways. We also are closing our financings. We have a little bit left to go. So any investor out there that wants to take a look at our stuff, we have incredible lead, and we're happy to have those conversations.
Awesome. No, very, very collaborative. And on the tech side, do you have like, what kind of tech would you need for a new market when you come in?
Oh my God, I need tech.
Uh,
That's one thing that is like, we're really, one of our strategic pillars this year is radical transparency, because as you scale manufacturing, like scaling ERPs and scaling just-in-time batch manufacturing is really critical. So if anybody has a really great ERP or tech that they're building out, I'd love to take a look at it. We have some partners today, and we're looking at what's the best way to scale this. And so we're definitely exploring better and new tech.
So one question I have is on these, like, so partner selection, obviously in California, you're in addition to, making your own brands, you're providing kind of a co-manufacturing facility where people can come in and make their brands. But normally that creates channel conflict, right? Because you are really good at making pre-rolls, and somebody says, well, I want to make pre-rolls, and you already make pre-rolls. So, now you take those companies also with you into new markets. Is channel conflict a thing, or is it like, look, we're just 2 small pre-roll manufacturers, or 3 of us all make gummies? At what point is there real friction in that relationship that you got to step through? And at what point is like, you know what, we're not really competing with each other. We're competing with the other ones that are on the other shelf, the other manufacturers. How does that all play out in terms of channel?
Yeah, it's a good question. A lot of investors ask me this question because people are really interested in, like, especially on the contract manufacturing side. And so, and in the expansion side. So one thing that I always will say is, look, Garden Society is our brand. So like, don't expect me to do an exclusive against myself. Like, duh, no, I'm not going to do that. But I think what all of us recognize is that we're competing against the illicit market. We're also competing against markets that are incredible white spaces in the emerging markets. So like when we think about California, we think about the size of the regulated cannabis market in California and the size of the illicit market in California. There really is no channel conflict in that capacity. Like, we've never run into it in a real way. We've never had a retailer confront it. It's only actually benefited all parties. So there's much more synergy than there is conflict. We always talk about, like, the sum of the parts actually compete stronger against the illicit market or against the, open space in the regulated market. And then as we go into these new markets, I think it's going to be interesting with MSOs with channel conflict down the road potentially. But as of right now, people are really excited for differentiated quality products. We've had tremendous response on our products in Ohio for being full spectrum, highly efficacious, delicious, educational. So like the interesting thing as the legacy Cali operators, when you look at the product in these emerging markets, especially 2.0 products, so not flour, but pre-rolls, vapes, gummies, fast-acting technology, like really like products that compete in California and bringing them into the new markets. Consumers are so excited to have access to the next level, and brands are so excited to have expertise to help them get there in a consistent, quality forward way. So far there is no conflict. How that plays out in the next 3 to 5 years, I think, is a little bit TBD.
Can't help but ask you one parting question. New York.
New York. We talk a lot about New York, you and I.
Like, there's quite a bit of evidence that California brands are already have a very significant presence in New York.
Very significant, yes.
Shocking, right? I think New York is funding the growth of a lot of California cannabis brands at this moment. But you look at that market and you've got your hub and spoke, and you look at that as like, look, I mean, not to oversimplify it, but CPG kingmaker is the state of New York, right? And all the capital markets and all that wonderful thing. And we all read about the kind of the slow rollout. But at what point does it feel like you're ready? Like, there's this always like, I want to be first. I don't want to be first. I want to be there when there's relevance and I can sell. And how do you look at a state like New York that is so critical to your business in the long term? And when you see kind of we don't have to just call it a botched rollout, but a painful rollout, how do you look at that market and say, all right, for a company of my size, hub and spoke, what have you, here's how I have to cope with New York. Here are the ways I have to resist the temptation to dive in early, or how do you think about it?
Yeah, I mean, I think, one thing about cannabis is everybody has FOMO. I mean, you can just see it by the quantity of conferences that this industry has for the number of attendees available, right? Like how much FOMO exists in our industry is just unbelievable to me. And so, of course, New York is important and relevant. For us, like, we really want to be capital efficient. We are a small but mighty team, and we focus on execution. So if I think about New York, capital efficient, execution, small but mighty team, like, it just isn't there yet. We're building incredible relationships with New York operators. They come to our facility. We are advising them. We're supporting each other. There's a lot of collaboration with people who are operating in New York. But like, really, our golden goose is Jersey, because we feel like once we get Jersey up, then that gives us permission to do everything else. So we will do New York when it's right for the business to do New York, and we have the resources and the capacity to focus on it. And we have the regulatory and operational framework to be successful. Right now, I know a lot of companies are tying up a lot of capital in New York, but there's now 2 retailers where to sell product, right? And so, just from a scale and efficacy point of view, it just doesn't seem like a good use of time or resources until things are a little more rolling over there. And so maybe that's the wrong decision.
Is it as simple as the number of stores that are open, or is it really more about finding the right partner? And because you said New York's a spoke for you rather than a hub.
Yeah. So we actually think we might have the right partner already identified that we've been working with for a while, and we've been collaborating with, and they've been helping us in Jersey. We've been helping them in New York. What printer do you use to print labels? Okay, this is how we do it. That kind of stuff. So we've actually been building deep relationships with some operators in New York. Obviously, we have a ways to go before we're ready to launch products in New York, and we really need the regulatory and infrastructure to like settle out so that there is a path. It's one thing to make product, it's another thing to commercialize and sell it. And so, we don't participate in the illicit market in New York. And I do agree that that's how most California companies are growing these days. So right or wrong, we just chose not to. And we're really excited when New York really starts to open up and starts to really have a regulated framework and market for consumers with quality products, and think we will have a pretty expeditious path to it when it's time to go.
Great. We have a good question speaking about New York. We got a question from a New York cultivator asking if you can speak to the sourcing of genetics and building cultivation relationships in a new market.
Yeah, this is really interesting and something we're really exploring right now. We've had tremendous success with our genetics in California. We have really incredible partners. We work closely with Emerald Spirit Botanicals. They're a legacy farm in Mendocino County, family owned, family run, incredible genetics that they have. We also work with another incredible cultivator in Sonoma County that has Joy Ridge. They have an incredible flower that they grow in greenhouse, outdoor. They're just really, really good. What's really interesting as we expand is how do we create product that honors the genetics and also is distinct and unique, but also the lack of sophistication somewhat of the cannabis consumer. So we've really created what we feel is a roadmap to products where some of it doesn't necessarily depend on the genetics. Some of it is effect driven. Some of it is specifically focused around, the gummies, the chocolates, the flavor profile, things like that. Also, what's really unique, in every market has different regulations around minor cannabinoids. So we launched a THCV product line in California that's gone out of the gates gangbusters and had tremendous success. THCV, if you don't know about it, it's a really cool minor cannabinoid. It's energetic, it's uplifting. It's like a shot of caffeine in the middle of the day that doesn't give you the munchies. And so in Ohio, for example, they are required to be hemp-derived minor cannabinoids. So there isn't the minor cannabinoids available in California. In California, they're required to be on metric in cannabis-derived California. So, the regulatory framework drives a little bit of the genetic requirements of how we participate in minor cannabinoids and how we continue to scale that. But I think it's something we're really interested in exploring is genetic relationships and partnerships and how we continue to scale that, because as the markets, emerging markets become more sophisticated, it's going to be only more important to have access to those genetics and in the quality way, grown correctly, so that they can be used in a finished product. I think New York has a real interesting opportunity with the level of sophistication and cultivation to really do cool genetics out of the gate. So I'm excited to see how that starts to play out. And I think it'll be interesting.
Yeah, no question. Lot to discuss there. And then last question, which I got a couple questions here on what do you think about Vermont and what do you think about the future of Illinois? And I'm going to frame that in the context of sometimes people say, oh, I've got to be in New York, New Jersey, Illinois, I got to be in the big states. Whereas there's a lot of people making money in Vermont and Maine and Connecticut.
Yeah.
And, you know,
Ohio.
how do you look at that in terms of, you know, big state versus small state, and how relevant is that into your decision-making process?
Yeah, I mean, I think it's a really interesting question. So for us, we try to balance opportunistic situations. So like, what's our is there an opportunistic or an advantage way to get into the market? What's the total addressable market? What does the supply chain look like? How easy is it to get into the market as manufacturers? Like, can we source? Can we sell, for example? So like, is there a gate in the supply chain that's going to prevent us from becoming successful? And then I actually am a big proponent of small markets. I think they're a really interesting place to learn, to practice, to grow. I also can only do so much. So like, I haven't really looked at Vermont, just in total honesty. It's really far away from us. So like, you know, I think geographic plays a role for us personally as well. And then I think it's going to be interesting with distressed assets for Michigan, for Illinois. There's a ton of opportunity to take over distressed assets in Illinois. There's a ton of opportunity in Michigan. So how those markets stabilize, I resonate because of California and the situation happening in California and how we've been able to stabilize California. So I think eyes are on them, but you know, right now really focus on executing the markets we're operating in.
Awesome. Well, we've run out of time. You and I could probably chat for another hour and a half for sure. Easy. We'll have to do that at Lagunitas or sometime soon here.
As long as there's a beer.
But thank you so much for joining us.
Thank you for having
me. Story and execution strategy you've been working on. You are a badass. We're looking forward to following your progress. And thank you so much for coming on. And just a reminder to everybody, 25th of February, we're going to hear George Allen from Lowell's talk about his strategy for best practices and brand expansion. So please come back and join us. That should be February 22nd, not the 25th. Thank you all for joining us today. Aaron, bless you, and looking forward to hearing more about your successes.
Thanks,
Good night, everybody. Good day, everybody.